Hey there, welcome to the Open. Happy Friday. TSX ending at a record high yesterday. Let's see if it can push further into record territory today. And let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canadian retail sales saw a decline in December, but they are apparently on track to rebound to start the year. Data from StatsCan indicates that receipts for retailers dropped 0.4% in December, but they are expected, according to a preliminary estimate, to increase by 1.5% in January. The agency says despite U.S. tariffs fueling uncertainty, consumers continued to shop in 2025, with sales increasing versus 2024. Some of that, though, was supported by a rush to buy cars at the start of the year as consumers tried to get ahead of tariffs. Shares in Hudbay Minerals down in the pre-market after the company posted fourth quarter revenue and profit that missed estimates. The company saw production declines across gold, zinc, silver, and copper. However, revenue did increase 25% year over year because metal prices were higher. Altus Group posted a loss in its latest quarter, as well as revenue that missed estimates. The Toronto-based commercial real estate software firm says its loss from continuing operations widened to just over $5 million. However, Altus is forecasting revenue growth of up to 6% for the full year. U.S. futures down. The latest read on U.S. economic output, GDP, weaker than expected. Well, let's get back to those Canadian retail sales. There was a sluggish end to 2025, but it looks as though there was a mild rebound last month. And the Fed, of course, has another data point to digest: U.S. GDP falling short in the latest quarter. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much indeed for joining us. Start off with the retail sales, if you would. Are they an important metric for the Bank of Canada?
Good morning, Andy. I would say yes, they are an important metric for the Bank of Canada. Having said that, it's not like the U.S., where U.S. is a consumer economy, where the consumer spending drives the economy. I would say in Canada, we're more of a housing economy, from the jobs created through housing, as well as the spending for durables because of housing is a bigger driver. So retail sales is important. The Bank of Canada will be encouraged by the number that we see. We'll have to see if this trend continues or if the actual number is close to the preliminary estimate. But it is a good thing, and I think it reflects increasing consumer confidence.
Looking at the fixed income markets broadly, you think there are increasing signs that investors expect one cut from the Bank of Canada, interest rate reduction this year?
Yes, and what's interesting is towards the end of 2025, the market was expecting a hike or a percentage, a chance of a hike in 2026. Our team did not believe that. We always believed there'll be cuts in the market. We were calling for 1 to 2 cuts in 2026. Despite the market discounting hikes, we still believe there's going to be 1 to 2 cuts. We ultimately believe there'll be 2 cuts this year. And the main reason why is CUSMA. The uncertainty around that. You saw in the Bank of Canada minutes that they actually highlighted increased uncertainty because of Donald Trump. And to me, that's like words that open up the easing possibility again. And we think if they're going to ease once, they don't ease once. You know, if you're going to ease, you ease twice, because you think you need to impact the economy somehow.
The housing market, you don't see much of a turnaround there this year?
No, unfortunately not. We don't see much of a turnaround just because of the inventory overhang. You have to get rid of the inventory overhang in regards to new condos, new townhomes being built. The key way to doing that is lower interest rates. You lower the price, the entry costs of housing affordability. That's helpful in getting rid of that overhang. We do, however, believe that the overhang will be taken care of in 2026. So we do see us coming close to the lows, but we haven't turned around yet.
What about the States? A weakish number for the latest period on GDP. What is your take on the U.S. economy? Is it just ticking along nicely?
Yeah, ticking along very nicely. And when you look at the details of the surprise weaker number in GDP, the biggest driver was government spending or lack thereof, and that was driven by the shutdowns. So a little bit of noise in those numbers. They're actually better than they look because if you kind of remove the government shutdown. So yeah, we're very constructive of the U.S. We believe they're on an upswing from a growth perspective, and we believe this will be the low print for, represents 2025, but the low print in 2026. So
can President Trump claim that he's done a decent job of preserving, keeping economic growth solid, even though, despite the massive disruption around tariffs?
Yeah, you know what? I smile because I think he'll proclaim that no matter what the number is. Right?
Yeah, that's true. Yeah.
If it's a low number, it's someone else's fault. If it's a good number, it's his. So he'll proclaim that it's good without a doubt. But yes, and you have to remember the key thing in the U.S. right now is that the tax refunds are coming out. They're going to hit consumer pockets, and that is expected to be significant due to the tax reduction from the Big Beautiful Bill. And those refunds come February, March, April. So we expect that to be very supportive of the U.S. economy, at least for the next several months. And we think that'll play throughout the year. And
just finally, we're very tight for time, but you're generally saying if you have a bond portfolio that you're managing, keep it short because there could be drops in bond prices, rises in interest rates?
Yeah, we're saying two things. You want probably a maturity of around 5 years because there's more volatility outside of 5 years. And the second thing, which I think is more important, you do want to have own corporate bonds. We do believe this is a supportive environment for credit, for risk assets, and we are overweight credit and risk assets, and we'll go more overweight if the opportunity presents itself.
We'd better jump. Earl, thank you very much and have a great weekend.
Thank you. You as well.
Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Coming up, Canada and Mexico are stepping up efforts to deepen trade ties. With Canada's trade mission to Mexico wrapping up, attention now turns to a broader review of the Canada-US-Mexico trade agreement. And there are concerns that it could be in jeopardy. CTV's senior political correspondent Mike LeCouture filed this report.
It's about time that we are less reliant and more resilient.
Finance Minister François-Philippe Champagne believes Canadians understand the reality of the situation. While President Donald Trump continues to say he could walk away from CUSMA, the New York Times is reporting 2 Canadian officials involved in trade discussions say expectations for a full renewal of the deal are very low. Still, the minister isn't ready to give up hope yet.
So we'll continue to make the point and keep telling them that we're ready at the table whenever the parties want to review CUSMA.
Now, it comes as the minister overseeing trade with the U.S. just wrapped up a trade mission to Mexico.
There's no division as between the interest of Mexico and Canada in committing ourselves to the trilateral trade agreement.
Canada has ripped us off for years. Not anymore, they're not.
This trade expert believes threats from the White House are part of the negotiation, but Canada needs to continue making a case for CUSMA.
To members of Congress, to state governments, to U.S. business, to underscore how important this agreement is to the United States.
Now, there is a sense of urgency to end the trade war with the U.S., According to Statistics Canada, this country's trade deficit grew to $31.3 billion last year, the largest since the COVID-19 pandemic. Overall, exports were down slightly, but the Canadian economy is slowly shifting away from the U.S., with 5.8% fewer exports going south. And exports to countries excluding the U.S. rose by 17.2% in 2025.
We have what the world wants, whether it's gone from critical mineral, from energy, from natural resources.
The finance minister adds while Canada wants to work with the U.S., there are other trading opportunities out there.
CTV's Mike Le Couture. Up next, North American partners, trade partners, are focusing on cooperation. But U.S. President Donald Trump is reviving an unusual ambition of his own. He is renewing interest, apparently, in acquiring Greenland. That's ahead. The U.S. president's threat to annex Greenland has intensified doubts about the integrity of NATO. This week's Bloomberg doc steps back to take a closer look at the U.S. president's public justifications for that proposed land grab.
For decades, a 1946 U.S. offer to acquire Greenland from Denmark was a state secret. The exact offer is unknown, but U.S. diplomats had previously floated a price of $100 million in gold. But it was a non-starter. Greenland was not for sale. Sound familiar?
We need Greenland for national security. One way or the other, we're going to get it.
President Trump plans to buy Greenland. Is that how this ends?
It wasn't. But even if it had, how does one price an island that you think secures a hemisphere?
What is, for example, the value of being able to stop a missile before it hits New York City?
While the security rationale seems to be quite strong, the economic case is not so clear.
In the end, Trump relented, and many pointed to a 1951 agreement with Denmark that already gives the US wide military access to Greenland. But then again, few ever believed the issue was really just about security.
It's clear that President Trump wants to recreate the sphere of influence of the United States over the Western Hemisphere.
Greenland is very keen to do more business and trade more with other nations. At the moment, most trade goes through Denmark.
Back in 1946, at least one answer to how much is Greenland worth was $100 million. Today, it's basically more money than you could print. So perhaps it's worth reframing the question. In the 15th century, Greenland's 500-year-old Viking colony vanished. Theories as to why make for fascinating reading. Then, slightly more recently, in a room at the World Economic Forum, a similar thing happened to President Trump's threat to buy or besiege the island.
What exactly happened in that room? We all saw Donald Trump on the podium.
We want a piece of ice for world protection.
Goes into a room with you and he says he has a framework for a deal.
The details of that deal are still emerging,
but for now seem to exclude his long-desired acquisition.
Trump first floated the idea of buying Greenland back in 2019.
He revived the idea again after winning his re-election in 2024.
He presented it as essentially this big real estate deal that would ease Denmark's finances.
Some background on that. Greenland is a semi-autonomous part of the Kingdom of Denmark. It sets its own domestic policies but relies on Copenhagen for about $600 million of annual grants to fulfill them.
Greenland's economy is very small. Fishing makes up almost all exports.
And its people are proud of that. Reliance on the sea is deeply embedded in Greenlandic life and culture, though the island is trying to diversify.
It's betting on tourism and mining, but progress is just very slow. That's because of a range of factors: high costs, limited infrastructure, harsh weather, and especially the lack of skilled workers.
In Trump's view, the American taxpayer could assume some of those costs and investments. But why would they want to? Greenland lives here in the Arctic Circle, and it's considered strategically valuable for several reasons.
First, the island is a critical location from which to monitor missile threats potentially coming from Russia. Russia's posture in the region has become much stronger. The country has been conducting drills and also signaling that in the future it might be willing to pursue much more forceful approach in the region.
The US has a military base in northern Greenland called the Pacific Space Base, where it has a radar system that monitors space and can detect missile launches.
But Trump had grander plans.
All we want from Denmark is this land on which we're going to build the greatest Golden Dome ever built. We're building a Golden Dome.
Golden Dome is President Trump's proposed missile and air defense program,
which involves deploying ground and space-based technology that doesn't yet exist, within a system many experts warn may not work. But there's another reason emerging as the world heats up.
The more that climate change leads to melting ice, the more that region is going to open up for maritime trade.
And in this extreme scenario, new routes would replace the polar ice cap. But this is a relatively small win, as rising sea levels would put low-lying cities like Rotterdam underwater. Routes across the Arctic can be far shorter than traditional passages, like the Suez Canal. With $1 trillion worth of goods passing through the Suez each year, even a small shift or expansion to the Arctic could be lucrative. Now, you'll remember there was another argument that Washington used to make its case for owning the island.
One thing that has kind of surprised me is how the rhetoric has shifted. If you look at what President Trump was saying in 2025, the main reason to have Greenland was all about critical minerals and rare earth.
There is a Danish geological survey showing that Greenland might have around 35 deposits of so-called critical minerals.
Things like lithium and platinum group metals. According to the US Geological Survey, Greenland contains about 1.5 million metric tons of rare earths. But that's low compared to places like China, Vietnam, or Russia. And we don't even have data for nations like Madagascar or Thailand, where rare earths are being extracted at high levels. Having minerals in the ground is also not the same as bringing them to market. And that's the problem with Greenland. On paper, its strategic advantages are clear. Making use of them is another matter.
So far, the experience of 50 years of drilling for commodities in Greenland has indicated that there is nothing commercial there to be exploited.
Greenland only has 2 small mines, one for gold and one for anthracite.
Most of the deposits that people are looking at are far north, north of latitude 50, which means that it's almost winter permanently. It's very, very difficult to exploit.
You have to build everything: roads, runways, ports, housing, power, supply chains, and in quite remote Arctic locations.
So now Washington's argument has moved on.
There's certainly far more attractive places to mine for rare earths. Our interest is national security.
Whatever the interest, those fundamental obstacles, like big blank spaces on a map where roads need to be, remain the same. They also constrain the island's attempts to connect more directly with the world.
Greenland opened a new international airport in Nuuk, and the hope was to expand links and direct connections to other countries. But in the first year of being open has faced disruptions because of the weather. I personally had 2 flights cancelled on a trip to Nuuk last year because the plane simply couldn't land.
Which makes control of Arctic waterways essential for cargo ships and naval vessels alike, no matter their origin.
Russia and China, they're ramping up their presence in the Arctic, and Trump is very worried about that.
Which is why he says his Golden Dome should be anchored in Greenland. But putting aside whether it would work, what would it cost?
We estimate, and this is a little bit of a departure from what President Trump has said the price tag of the program would be, that it could cost up to $1 trillion based on us going through and looking at each individual component, from satellites to fighter aircraft to the munitions that they use.
True, only part of that cost would be attributable to Greenland, but the island makes anything logistically ambitious financially chilling. It's estimated that it already costs the US between $50 and $200 million a year to run a single overseas base, and that's before factoring in building one somewhere like this. So a back-of-the-envelope cost-benefit analysis of Greenland has already gone multi-envelope. But Trump's original plan also prompted fears of the death of NATO. Maybe before we cost up a NATO-less existence, it's worth understanding why Greenlanders insist no amount of money could buy their sovereignty in the first place.
A key message is that they have the right to define their own future.
I think that's what sometimes when people miss. We want to collaborate, we want to set up partnerships and enhance the Greenlandic economy, but it has to come through the Greenlanders. We are 56,000 people living here. We will be so reliant on external factors and collaborators. People are, of course, against any American interference, but I think to a certain extent that's wrong. Americans are welcome here as long as they respect our norms and value. I really just hope that tourism will play a vital role in the Greenlandic future and the economy, because it's about preserving nature, it's about preserving culture, and it's about preserving what we all love and really have to take care of. We're basically living in one of the last untouched ecosystems on Earth.
After Trump's rhetoric cooled in that Davos meeting room, NATO allies permitted themselves a conditional unclench. After all, Denmark, Greenland and the US all fall under NATO's security umbrella.
The alliance is premised on the idea of mutual defense.
An attack by the United States against Denmark over Greenland would end NATO as we know it.
So the stakes were just extremely high.
I think it is fair to say that the European Union and the United States are not going through the best moment in their relationship. There have been strong tensions, and Trump statements and threats over Greenland are just the latest episode.
There are growing concerns about the threat that Russia poses to countries like the Baltics, who President Putin very much sees as part of Russia's traditional sphere of influence. If he believes that NATO is no longer the ironclad alliance that it once was, he may be emboldened to take more actions against that eastern flank.
Models of a Europe-Russia war involve vast loss of life and extraordinary financial repercussions.
We've estimated that it could cost the global economy over $1 trillion, but in many ways the cost of that conflict would go beyond what we can quantify.
In February, NATO responded with Arctic Sentry, a mission to expand its regional presence, and for now, the alliance endures. You can put numbers on parts of Greenland, on bases and radars, and to some extent minerals and trade routes. But those estimates only tell part of the story.
Nature is directly related and embedded to our way of lives. So we could never live without it. It's what we have here that is so important for us, and we don't want that to change.
Greenland's true value, perhaps, isn't what it would cost to buy, even if it were for sale, but what its inhabitants and the world would pay if it were lost.
Okay, let's give you a quick update before we go to the market, the opening bells. A quick look at an ETF that tracks Canada's energy sector. XEG touched on this one yesterday. It has been hitting the highest since 2008, when you remember oil very briefly went north of $130 US. Look at that, driven by our giant oil sands stocks. That one up more than 35% in the past year. We have those opening bells next. Here are the opening bells at the NASDAQ. Red Cat Holdings is doing the honors. In New York, it's a crowd called Starfighter Space, and they are using fighters, U.S. fighters, dating from the 1960s to help launch payloads into space. That's the F-104 vintage aircraft. Wow. TSX, it's Blossom Gold, celebrating the company's new listing in Toronto. It's time for the first 50. Trading is getting underway. Let's see if Toronto is in record territory yet again. Nope, not right now. It did close at a new high yesterday, slipping in early trading. And we're also seeing a little bit of selling south of the border. We got that weaker than expected read on GDP, but the U.S. economy, as we touched on with Earl Davis earlier, is doing just fine, broadly speaking, although there are signs of cracks in the labor market. Some stocks of interest here. Hudbay, it looks as though investors are slightly disconcerted by the forecast from the company. Costs look like they're higher than had been expected, or at least CapEx is higher than some analysts had expected. And the company, though, is in such a fortunate position with all its other minerals. It's, in theory, producing copper at a negative cost. It's getting paid to produce copper because it gets so much for other metals that come out of its properties. And let's have a look at Lundin. Lundin Mining, we are going to be hearing from the CEO shortly. All eyes are on their Vicuña project on the border of Argentina and Chile. It's way, way up. We were talking about altitude, and it's going to be a giant copper mine when and if they get building it. We'll hear more from the CEO shortly. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Great to see you. What's going on with LyondellBasell?
Yeah, LyondellBasell, this is one of the stocks that's worth watching today. It has been moving in a very volatile range to start the session here. And in the pre-market session, this stock was down as much as 12%. It did trim those gains a little bit. But 12% is a huge drop for a company that is in a stable business of oil refining and typically is a big dividend payer. You have a stable income stream and a stable product stream, and they've cut their dividend by 50%. They've cut it to 69 cents per share, and that is driving the stock lower this morning. The company, the CEO said in the release accompanying this that it sees, markets expected to remain challenged over the course of the year, and that is the move to try to conserve some cash and cut the dividend, like I said, in half. Now, what we're seeing right now in the regular trading session, 2.5%, is much more muted than what we saw in the pre-market session, but this is worth watching anyway. Just 12% pre-market is a huge move, worth watching over the course of the session.
And we heard from another chemical company, Chemours.
Yes, that's right. Another big drop here, 9.5% lower in the pre-market session. Worth watching again. You know, chemicals have been under pressure, partly because of tariffs, partly because of feedstock costs, et cetera. What you have here is a company that put out both fourth quarter results that missed expectations. The company sees, fourth quarter results missed, and also over the course of the full year, they see at the midpoint $850 million in EBITDA this year. Wall Street had expected $883 million, so that is a meaningful miss. The stock is down as a result. Analysts were out this morning saying that given the weak end markets for the products here, the companies need to, and specifically Chemours, really needs to focus on cash, on maintaining its cash position. So we're seeing a decent sell-off here this morning.
Thank you very much, Jeff. That's Bloomberg's Jeff Morgan. Coming up, how a rotation out of mega cap tech names could play out over the course of the year. That's next. Investors are grappling with what comes next for mega cap tech amid concerns about heavy AI spending. Our guest says a rotation out of those big tech names could unfold throughout the year. We're joined now by Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Thanks very much indeed for joining us. Yesterday, the Financial Times had a story that a price war may be emerging in AI. Chinese engines have slashed prices. Now, of course, they may not be allowed into the West, but it's interesting. How much money will people pay for AI, I guess is a question.
Yeah, Andrew, I think that's been the story that we've seen since the end of October, where investors are looking at those valuations and trying to say, how much do we want to pay up for growth? And we've seen, obviously, over the last several weeks here in 2026, software companies disproportionately punished, and then that rotating last week into some other sectors of the economy where AI disruption and concerns started to play out. I think the bottom line, where we are right now is I think investors are in a show me position where they're looking for more clarity from some of the bigger names like NVIDIA, who has earnings next week, Obviously curious to see how this round of cap raising and funding goes for OpenAI and at what valuation is going to be placed on that big name in the space. But I think bigger picture moving forward is that there's been a real focus on cyclical growth in the U.S. and policy support that has moved investors to look at valuations, look at earnings outlooks, which is why value is trading a little bit better than growth. But I think over the balance of the year, if outlooks for growth still hold for some of these major AI names, I don't think technology is technically in the penalty box longer term. But I think we need to be a little bit more cautious and a little bit more focused on allocations over the course of this year.
And broadly speaking, though, U.S. corporate profitability is still growing. I know a lot of that has been and is the big tech companies.
Yes, and so I think that's a fair point, but I think it's also the distribution of growth. So when we look at earnings outlooks for the balance of the year, we're expecting 2026 with publicly traded companies growing about 15% year over year in profit growth, but bigger contributions coming from areas outside of tech due to the impacts of fiscal reform through the tax bill, spending in CapEx, steepening yield curve that should help financials. Healthcare always seems to perform a little bit better in a midterm election year domestically here. So you have a little bit more of a balanced view on earnings growth, and I think the market is sniffing that out right now. I think once we get past the second half of the year and you look at 2027, we see more of a fiscal drag happening within the economy. And I think over the second half of the year, we're going to get a little bit more clarity on this, on the AI innovation investment thesis and that next wave of where AI innovation could play out. So I think in the interim, staying broadly diversified across both large, medium, and small growth and value makes sense until we get a little bit more information. And at the same point in time, I think tech is still a big contributor to earnings, like you said, Andrew, and something that investors should still hold in their portfolios accordingly.
Would you be inclined to pile into big banks, not necessarily talking about these stocks, but the likes of JP Morgan and Citigroup?
I think financials right now is quite interesting. The big banks have had a pullback recently. So there is some value there for sure. And also, I think it's worth looking at some of the regional banks as well, because they'll have more of a contribution to profits as loan growth potentially accelerates with economic activity over the course of the year. And also with a steepening yield curve, they get more of a bottom line contribution based on net profits from loans. So I think big banks with the recent pullback look attractive, but I think also looking at some regionals also makes sense.
And what about the consumer stocks? Obviously, General Mills, a classic defensive consumer name, reporting pressure on consumers. That happened a few days ago, and that put pressure on other packaged goods companies. Are you seeing value there?
Yeah, so the consumer staples and some of those consumer names right now are trading at forward PEs, actually very similar to their peers in the tech space. So I kind of see the consumer staple names actually as quite expensive. And also with the recent data that we just got on GDP numbers and PCE numbers as another key inflation gauge for the Fed, we're seeing that quarter over quarter, yes, consumer spending is holding tight, but it's actually in a decline on a sequential quarter over quarter perspective. So when the froth kind of wears off on these tax refunds that are coming through over the next couple of months, and higher income earners spending a little bit more in tax due to increasing obligations through long-term capital gains, I think in the second half of the year, consumers are going to continue to be very sensitive to price, which is why we're not necessarily looking at following through on this consumer discretionary trend in the short term, and actually looking for areas of value outside of the consumer discretionary and staples areas, such as financials, healthcare, industrials, some aspects of utilities are kind of playing into the CapEx spending cycle, and also just the changes in the potential yield curve with profits still being durable for companies, as mentioned before.
Brian, thank you very much indeed. Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Yesterday on Market Call, we were joined by Greg Newman, Senior Wealth Advisor and Portfolio Manager at the Newman Group, Scotia McLeod. Focus was North American equities, and his top picks were NVIDIA, Colliers, and Microsoft. And today it's Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James, and she'll take your questions on Canadian and US large caps. Coming up, Lundin Mining just released fourth quarter results. We'll talk to the CEO about his plan to build a gigantic mining complex way up in the mountains on the border of Argentina and Chile. We'll be right back. Let's talk copper. Lundin Mining just posted adjusted profit that tripled over the past year, or since same period last year. Of course, copper has been trading near record highs, and the company has a big stake in a potentially giant project called Vicuña, located up in the mountains on the border of Argentina and Chile. Analysts say Vicuña is the future for Lundin. We're joined by Jack Lundin, CEO and President. Jack, thanks very much for joining us.
Hi, Andrew. Thank you very much for having me.
So just looking at your existing mines, two in Chile, one in Brazil, and you had production of just under 90,000 tons of copper in the latest year. So your annual run rate from those mines is about 360,000 tons of copper?
Yeah, just about. So in 2025, we had a really solid year for Lundin Mining. The third consecutive year where we were able to hit our production guidance on all metal categories that we're producing. So copper and gold mainly. In 2025, we produced 331,000 tons of copper, and that translated into record financial performance for us. We generated over $4 billion in revenue. But if you look at the fourth quarter, which is indicative of current times, we generated over $1.3 billion in revenue, translated to about $686 million in adjusted EBITDA, and really put us in solid footing for the year ahead. So we had strong financial performance, strong operational performance, and we're really pleased to say as well, we had a record performance in terms of safety with our lowest injury frequency rate. So really hitting our stride as we come into what is a very exciting period for our sector.
Can we talk, and the stock doing just fine, traveling in the past year. Can we talk about this Vicuña project? It's going to be gigantic. It'll get up to eventually up to around 500,000 tons of copper a year. It's at least two mines, two deposits. So you own just part of it? How does that work?
Yeah, that's right. So our partners, BHP, along with Lundin Mining, each own 50% of a joint venture called Vicuña Corp. And on Monday, we were able to announce the preliminary economic assessment of this combined project, which, as you indicated, really outlines a world-class project in terms of scale. It has the potential to become top 5 in terms of volume of production for copper, gold, and silver. So all individual categories, this mine has the potential to be top 5. And on Monday, the preliminary economic assessment outlined very robust project economics. So at current pricing, at spot pricing, nearly $30 billion of net present value at an 8% discount and a 26% IRR. And so we're going to be developing this in a staged fashion, and we're very excited to kind of hit this milestone and keep driving the project forward with hopefully an eventual sanction decision as early as before the end of this year.
Now, but you would get half of the production essentially from the mine. BHP gets the rest?
That's exactly right. So it's an independent joint venture of which BHP and Lundin Mining each own 50%. And so the production would be split 50-50 between both companies. And so together we're looking at putting together an execution plan and moving this project forward through definitive studies. As I mentioned, it was a preliminary economic assessment, and we have further definition on stage one, which we would look to sanction before the end of this year. And pleasingly for Lundin Mining, which is really important for us, we were also on the heels of having such strong financial performance entering this year in a net cash position. Our revolving credit facility is on the cusp of being upsized up to $4.5 billion US, which means that we are fully funded for the stage one build on Lundin Mining side.
It's not going to be cheap, though. It's way up at a high altitude. And the initial spend, around $7 billion US?
That is correct. So we outlined a stage one capital expenditure of $7.1 billion US. Now, we have a lot of experience in the region. Our Caserones mine is just over the border on the Chilean side of the Vicuña district, where we're operating, and we have driven strong performance and learning a lot about operating at high altitude. And so I think we can translate a lot of those lessons from our Caserones mine. And of course, BHP, our partners, brings a wealth of knowledge in developing large-scale projects of this nature. So we feel very confident with the team that we have in place that we'll be able to mitigate any risks. And we really do understand this operating environment, given that we already do have a mine in full-scale operations just 40 kilometers away from where the Vicuña project is located.
Yeah, you got to bring in water. There's desalination. I guess it's straddling the border, or some of the infrastructure will be in Chile, and I think a lot of the production in Argentina. It's fascinating, though. In theory, you'll be mining copper at a negative cost because you're going to be getting so much gold and silver out of this thing, or at least gold.
That is correct. Both gold and silver are in a very impressive quantity next to the copper mineralization as well. And so the first 25 full years of operation, we will have a negative average cash cost of negative 20 cents a pound copper. And that's really due to the strong byproduct credits that are coming from gold and silver. And so, very robust mine, very unique in the fact that it has such high quantities of not just copper, but precious metals as well. And this is a project, that demonstrates scale that would interest a larger company like BHP to come in and look at developing. And so I think we're in a great position, and we have a great relationship with our partners, and we'll be working together to advance as rapidly as reasonably possible. And that's why I mentioned, before the end of this year, we see line of sight to getting to a FID.
Well, you mean, sorry, we're tight for time. You mean BHP might ultimately buy you out of the asset?
No, I think the intention is to continue to work 50-50 in unison with our partner. And we very much are keen to maintain a 50% holding in such a unique asset that really transforms the profile for Lundin Mining. Today, we're top 25 global copper producer, but when Vicuña is in full-scale operations, it will bring us to a top 10. And so we have every intention of pursuing that and really putting the pieces together to get Vicuña to a full scale, all while continuing to drive consistent returns at our existing operations, which we've been able to do for the past 3 years. And Q1 of 2026 is already shaping up to be very solid for us. So we'll look to build on that momentum going forward.
Thanks, Jack. Jack Lundin, President and CEO at Lundin Mining. Coming up, companies are spending big on AI, but which ones are actually spending wisely? And that's just ahead. There's been massive spending and big focus on this capex being slapped out by the tech giants on AI. But many companies are under pressure to make the right investments in their business. And the ones that spend wisely will often tend to reward investors. BNN Bloomberg contributor John Ehrlichman has a new story on our website on this theme. John hosts the investing channel Ticker Take on YouTube. John, you're talking about that crucial question, high returns on investments?
Absolutely, Andy. And I know it is important to talk about whether or not those big tech companies spend well on AI, but that kind of overshadows the fact that literally every company has to spend wisely. MIT had a study recently that found about 95% of the initial Gen AI pilots that companies were rolling out were not successful. So, yes, we like to talk about the biggest companies, but every company has to do a good job of managing their capital and investing that capital. There's a lot of metrics that get used. Return on invested capital is a very popular one with investors, including Kyle Taylor of TriDelta, who we spoke to in this story, which is on the website and on our Ticker Take YouTube channel. And he's got a very general philosophy about spending, whether it's in AI or other areas. He likes to describe these companies that he likes as self-help companies. They do a good job of helping themselves by spending their money wisely. So I like that because it's parallel to investors. You want to invest your money well. Companies that invest their money well in their business sometimes reward investors, as you alluded to.
Give us some examples of stocks that are seen as smart spenders, John.
Okay, so we have a list of 8 stocks, Andy, and that's in the story on the website. But just as an example, I know things have been rockier in the market, especially tied to this AI theme recently. But if you look at stocks like Deere or Cameco, 2 companies that in many different ways are benefiting from the AI boom. Deere, here's a company that's already nearly 190 years old. Kyle's view with them is, think about all the smart spending they have done to transition to help their big clients, farmers, to sort of buy new equipment that is geared for the robotics age, the AI age. You've got companies like Cameco, which, yes, in the sort of current time surrounding uranium, benefits from that. But as Kyle notes, they're very smart about not spending extra money until they have their guaranteed contracts. So those are a couple examples. An example of a company, Andy, that has struggled this year is Roblox, getting caught in the downdraft. It's lost about 20% of its value. But Kyle says that misses the point of the fact that they have a massive platform that arguably is still undervalued and a lot of levers they can pull and have smartly pulled over the years to build their business responsibly, and AI could benefit that as well.
John, thank you very much indeed. As
Thanks,
John
Andy.
mentioned, you can find his full story on our website, bnnbloomberg.ca. And John Ehrlichman hosts the Ticker Take YouTube channel. Up ahead, Canadian energy stocks hitting record highs for the first time since 2008. We'll find out, drill into whether that trend can continue, and get some takeaways on earnings season. Welcome back. It's the second hour of the Open. Here are the big stories we're bringing you from our newsroom. Canadian retail sales saw a decline in December, but they're on track to post a rebound to start the year. StatsCan says receipts for retailers dropped 0.4% in December. But in a flash estimate, the agency suggests that those sales are expected to have risen 1.5% in January. StatsCan says despite U.S. tariffs fueling uncertainty, consumers continue to shop in 2025, with sales increasing versus 2024. That was partly supported by a rush to buy cars at the start of the year as consumers tried to get ahead of tariffs. Shares in Eldorado Gold under pressure today. The company warns that production will be lower than expected due to the delay of a key mine startup. Eldorado says the mine in Greece won't start output until the third quarter of the year. It was previously expected to be up and running this quarter. Right now, stock down 8%. This means a 15% decrease in the company's production forecast. The Bloc Québécois is pushing for an amendment to the budget bill that would require banks to reimburse customers who experience fraud. The Bloc's finance critic says Canada's big 5 banks have dodged responsibility toward customers for too long. adding that this amendment would shift the burden from consumers to the banks. Reported fraud in the first 9 months of 2025 totaled more than $540 million. And the TSX once again trading in record territory, a new high for our benchmark index. Now it's chasing 34,000 big traders right now in Toronto. Brookfield Asset Management edging up. Magna under a bit of pressure, down $1. And I'm just looking at the heavily weighted stocks, the mix showing for the gold miners, but Royal Bank is up, and we just saw Cameco is up as well. It has increased about 3% today. And there's a look at the US markets, and they have now turned positive. You'll remember they did open in negative territory after a weaker than expected read on gross domestic product. The US President Donald Trump's sweeping global tariffs have been struck down by the US Supreme Court. The court said the president exceeded his authority by invoking a federal emergency powers law to slap his duties on trade partners, as well as targeted import taxes the administration say are addressing fentanyl trafficking. So that's a setback for the White House, and insofar as tariffs are bad for growth, investors seem happy right now. So we've seen this week Canadian energy stocks hitting their first record high since 2008, driven by surging oil prices. Cenovus is one of the Canadian energy names that our guest is interested in buying. We're joined by Denis Taillefer, Portfolio Manager at Coldwell Investment Management. Thanks very much indeed for joining us, Denis. Maybe we could pop up a 10 or a 20-year chart for XEG or the Canadian Energy Index. So we're finally back to where we were, or getting back to where we were in 2008.
Yeah, we are, which is interesting because you look back to 2008. I think the price of oil, the commodity, hit $145 or something, right? So we're in a very different environment today. The price of oil is much lower. And interestingly enough, if you look at the last year and a half or so, the price of oil has been under pressure, and yet the energy names have done quite well. And there's a couple of factors there, but one being really that industry as a whole is much more disciplined today than it's ever been in the past. Mm-hmm. And so we're not seeing the oil companies being so aggressive in reinvesting every dollar they make, putting that back into the ground. And there's a much bigger emphasis on returning some shareholder value here, right, through dividends and share buybacks. So the balance sheets are in much better shape. The industry is much more disciplined. And any of the firms that have decent catalysts and decent growth can do that in a disciplined way. Those stocks have been rewarded quite a bit. So we like the oil space here, the sector overall, and we have good exposure to it. The oil itself seems to be somewhat maybe oversupplied in the short term, but overall we think the industry is in a very good position here as oil prices recover in the longer term.
Cenovus is one stock that you like. Tell us what attracts you to it.
So we think Cenovus is one of the larger players that has more catalysts in play. We really like the MEG acquisition they made. Obviously, the assets were very synergetic. There's quite a bit of synergies that the company has been speaking to that they can produce over the next few years, $150 million a year this year and next, $400 million in total. We think there's upside to those synergy figures. And as well, this is a company that has just a lot of decent growth prospects in front of it, really through kind of brownfield type expansions, so lower capital intensity to be able to produce some decent growth to the bottom line. They've been improving their downstream operations as well. So overall, we like it. It's got quite a few catalysts we think that will play out over the next few years. It still trades at, we think, a slight discount to some of the other major players like Suncor and CNQ. It's just starting to break out off of that 5-year chart. So we think Cenovus is probably one of the better players in that larger cap space in Canada because it has more catalysts that will play out over the next few years.
Let's talk about a stock that you don't own right now, and you would, if you held it, you wouldn't be inclined to. You might hold it, but you wouldn't be inclined to buy it. Walmart. They actually just, I think I saw a headline. They just got overtaken by Amazon in terms of revenue. What would you be? And it is down. Investors didn't like the latest numbers from the company. What would induce you to buy Walmart?
So, the quarter was pretty good, actually. Overall, it was a good quarter. They slightly beat, top line and on the bottom line, and margins were improving. The same-store sales metrics were solid, were at the top end, even slightly better than what the market was expecting. So it was a good quarter overall. Their guidance was somewhat conservative. They tend to be conservative, and we think it's not a bad thing, bad place to be. Gives them probably a high probability of beating their quarters on a go-forward basis, which stocks tend to do well on that. They've got some strong catalysts behind what's driving that performance today. They're investing in their e-commerce platform. They have a new shopping assistant agent. That's the early numbers out of that are very encouraging. The shoppers that do use this agent, you see a pretty significant pickup in the average size of the basket. And also investing in their digital advertising, which is growing quickly. Their e-commerce is growing quickly. They're investing in automating their supply chain, which is really starting to see some impact on that SG&A. So as they leverage that, that will help margins as well. So we think the catalysts they have that are driving that, on top of the kind of fund flows you're seeing into more defensive stocks, are probably still going to be in play for a while. So from that perspective, we like the story. The valuation is what really kind of has us kind of step back a bit. It's trading at a very rich multiple. Again, momentum players, given the fact that some of these catalysts are still playing out, are probably more than comfortable investing here. But when we look at that overall space, we think there are other names that, from a valuation standpoint, are quite a bit more attractive here, because Walmart has had quite a good run here.
Here's another stock that you don't own, but you would be inclined to buy: Newmont Mining.
So Newmont Mining, for someone who's looking to get some gold exposure, if they're not there already, Newmont Mining is your largest gold producer in the world. They made an acquisition a few years ago. They've been optimizing their asset base. They've got a very diversified asset base. They're generating a lot of cash flow from an operations standpoint. They're doing very well. They have a new CEO in place. I think the market was really kind of looking to see what their capital allocation priorities would be on a go-forward basis. It looks like they will be accelerating or buying back more shares on a go-forward basis. So anything above and beyond the dividend, they will return to shareholders under the form of buybacks. So it's just an overall safe way to play if you want some gold exposure. We don't own Newmont. We have a few other larger players that we own in our portfolios, but we also have some smaller cap names that we think have more leverage, more catalyst to the stories that will produce more growth on a go-forward basis. But there's, Newmont's kind of firing on all cylinders here, and it's kind of a safe way to get exposure to that gold market.
I'm just checking these numbers here for Amazon and Walmart. So apparently Amazon hit $717 billion in sales last year. Walmart, which was the world leader, was slightly below $713 billion. However, almost $130 billion in those sales at Amazon came from web services. So it's kind of apples and oranges. Yeah. Thank you very much, Denis. I really appreciate it.
Thanks for having me, Andrew.
Denis Taillefer, Portfolio Manager at Caldwell Investment Management. Coming up, Vancouver-based Oceana Gold. We saw a rise in those shares after the company missed fourth quarter earnings estimates, despite record revenue. Oceana Gold just reported fourth quarter earnings. Company mines in the Philippines and the US and other places. It's tripling the quarterly dividend, and it does expect higher production this year. Excuse me. We were joined by Gerard Bond, the CEO of Oceana Gold.
The management over a number of years has had a plan how to get the portfolio right, get the assets performing as we've intended to, deliver on our production guidance. And what the increase in capital returns to shareholders shows is that we're confident in the future of the business, our performance, our growth, and with the strong balance sheet that we have, and given the returns that we've generated to the bottom line in free cash flow generation, it's time to give more back to the shareholders.
So will you be focusing less on M&As and also CapEx for 2026, or not so much?
Oh, no, we're investing much more in growth projects and much more in exploration in 2026. We've got a really exciting development called the Waihi North Project in New Zealand. That's one of the world's best undeveloped gold mines. And so we've got the permit and we're going at it at full strength this year. We also have the Palomino underground development at Hale that we're investing in. M&A, to answer your question, I mean, that's something that we always have a look at to see what's available. At these prices, it's obviously harder to find value in acquiring other assets, but we do scan. We look at everything.
Okay, yeah, you were mentioning some of those mines in the analyst call today. You also touched on labor cost inflation in that earnings call today. How much of an impact do you expect labor cost inflation to have in the year ahead?
Well, it's reflected in our guidance in the year ahead, which I would say that our overall all-in sustaining cost is expected to reduce by 7% year on year. That's as a result of greater production coming out of our largest producer in the Hale Gold Mine. On labour costs, we have real inflation that we have to deal with to keep our workforce appropriately paid. It's in low single digits. Labour is about 50% of our cost base, so we're seeing low single-digit inflation in our cost base. But as again, our 2026 all-in sustaining cost year on year is projected to be 7% lower.
Okay, yeah, and I know you say that's reflected in your guidance. You're also forecasting a 12% increase in output for 2026. I'm wondering, will labor costs factor into that at all?
No, it's quite the opposite. So we have an assumption about labour costs. So we're assuming our labour costs will rise with inflation of around 5%. And the increase in gold production that we're producing out of the Hale Gold Mine, 35% increase year on year. That unit cost reduces as a result of that growth in overall gold production.
Okay, got it. When we're talking about overall gold production for 2026, you say you're increasing production. What's your outlook, though, on gold prices and demand for 2026?
Look, the gold prices that we have today at around $5,000 an ounce are much higher than the $3,500 an ounce that we had in 2025. And that was a year where we made a tremendous amount of record free cash flow. I see the gold prices being around the $5,000 an ounce mark, could be higher. All the factors that have driven gold price to these levels seem to be still present. Central bank buying remains strong. De-dollarization remains a theme. Stagflation remains a risk, and geopolitical uncertainty remains high. So we don't set our business activity by reference to a gold price. We focus on safely and responsibly delivering our production guidance, keeping our costs low, maximising the cash flow generation. But certainly at these gold prices, we're primed to deliver even more free cash flow than we did last year, and that was a record.
Okay, so then my next question was going to be, like, what should the price of gold be for you to reach your dividend and buyback goals? But I take your point. Like you say, you don't really set your goals based on the price of gold. Is that right?
That's correct. And so at a price of gold even lower than it trades today, we're confident in being able to triple our dividend. We're confident in being able to double our buyback program. That gives a 112% increase in the $200 million that we gave back to shareholders last year. So we're really showing confidence in our business. We're showing confidence in the margins that we make from our activity and the future of the company.
Something also interesting is you plan to list on the New York Stock Exchange in April of this year. Why is that? Like, is the TSX falling behind as an option for Canadian companies, even mining companies, which obviously material stocks do quite well on the TSX?
Yeah, I mean, we've long been listed on the Toronto Stock Exchange. What we have uniquely is 50% of our gold production is based in the USA. And the USA is also the world's largest, deepest capital market. And we think that by listing on the exchange, in addition to remaining listed on the Toronto Stock Exchange, we will increase the universe of potential buyers, improve liquidity, and that drives value for our shareholders. But this unique calling card, as it were, of having 50% 90% of our gold production coming out of the USA just compels us to be on the New York Stock Exchange.
Gerard Bond, CEO of Oceana Gold. Coming up, we will dig into Live Nation's latest quarter, including a big jump in concert attendance and continued strength of Ticketmaster's high-margin ticketing business. Okay, well, I have the full Supreme Court decision here. Somebody in our newsroom printed it out in all its glory. There's a witch hunt on to know who tied up the printer. Anyway, so the Supreme Court in the States has said U.S. President Donald Trump not justified in using emergency powers to slap tariffs on trading partners, and also saying that he wasn't justified in putting on these tariffs allegedly to punish partners for fentanyl trading. And of course, Canada faced measures like that, even though there's evidence that not that much fentanyl comes into the States from Canada. So we did see a spike in some companies that bring in a lot of stuff to the United States. And Nike, for example, seen as vulnerable to tariffs, and a spike in that stock intraday. The Dollar Tree, like other dollar stores, is going to be bringing in a lot of cheap stuff from Asia. And you can see that stock. There's a 1 year, and you can see it's up around 3%. Lululemon also saw a spike. Yep, there you have it, just after 10 a.m., right on cue. So that stock moving up. The broad indices, though, they were higher, then they weakened a little bit. So, I mean, we have heard predictions that even if the Supreme Court voted down or ruled against Trump's tariffs, he would find another way to put them in. So there's the S&P 500 gyrating. It did spike actually just before 10 a.m. by our chart there, and dropped and then spiked. So it is higher. Apparently, investors encouraged that the tariff burden on the U.S. economy, was essentially it's consumers who pay these things, will be lessened potentially. Investors have been moving out of bonds, or they did move out of bonds initially. Let's get more from Bloomberg Washington reporter Tyler Kendall. Tyler, a fast-moving story. Just remind us, please, what the Supreme Court said.
Hey, Andrew, a pretty stunning decision by the U.S. Supreme Court in a 6-3 ruling, striking down President Trump's broad-based tariffs that have been enacted under IEEPA, the International Emergency Economic Powers Act. Keep in mind, President Trump has invoked this authority twice before, and this extends to both those tariffs, including those ones linked to fentanyl imposed against Mexico and Canada, as well as partly on China, too. The other set of those IEEPA tariffs extend to those broad-based ones imposed on the basis of a national security over persistent trade imbalances. That's part of the so-called reciprocal tariffs that we saw unveiled by the White House last year. Now, really importantly here, the justices are not ruling on the potential for tariff refunds in this decision, and this is going to set up a very complicated legal fight moving forward, because you have to keep in mind every importer, of which there have been more than 310,000 that have faced IEEPA tariffs, have to have a distinct claim in court. That is going to make this a very complicated process. Unless we see a lower court ruling, that's probably what's going to happen here. The high court's going to kick it down to the lower court. This is a 170-page decision. It just came down within the last 20 minutes, really. So we're still combing through all of the justices' reasoning here, but the headline, the pivotal part, is that President Trump's broad-based tariffs have been struck down, the court finding that he exceeded his authority. Typically, tariffs, as you well know, is something that's done by the U.S. Congress. Then they would delegate that as a federal authority in some instances. But IEEPA, that federal authority, has never been used for tariffs before, but the president's invoked it for sanctions, say. But this was the first case where we saw a legal case put forward by the White House on why they wanted to use IEEPA for tariffs, but the Supreme Court said that's not good enough.
Tyler, I know this is getting into speculation, but I have heard commentary to the effect that the White House or the administration would find some other mechanism to use or try to.
I don't even think that's speculation at this point. We have repeatedly heard from U.S. officials that they are going to pull on those other tariff authorities. In fact, if you look, they already have implemented a lot of those tariffs. Take Section 232, right? Those tariffs enacted under national security concerns that we've seen lobbied against those critical industries such as steel and aluminum, autos, pharmaceuticals. Those are all Section 232 tariffs and will not be impacted by this ruling. There's a lot of other options out there. Section 301, which would be allegations into unfair trade practices. We saw that used a lot during the first Trump administration against China over IP violations, as just one example.
Amazing. Yeah, did you say 300,000 plus importers hit by these tariffs? Can you imagine the amount of paperwork involved?
Well, I mean, definitely. 301,000 importers, and then that has amounted to $134 billion in revenue collected over the past year solely from these IEEPA tariffs. Again, as I mentioned, there's these other tariff authorities that we're seeing, but this is about to get very complicated.
Oh, my goodness. I guess the trade lawyers will be getting new Lexuses at the end of all this. Tyler, thank you very much indeed. That is Tyler Kendall, Bloomberg Washington reporter. Shares in Live Nation are up this morning. The company posted revenue in its latest quarter that was up 9%. Artists such as Bruno Mars, Harry Styles, and BTS of Korea have been breaking live ticket sale records amid an ongoing antitrust case over Live Nation's merger with Ticketmaster. Let's get more from Doug Arthur, research analyst at Huber Research Partners. Thanks very much indeed for joining us. Tell us about the latest quarter at Live Nation. What jumped out for you, please?
I'm sorry, Andrew, is that a question for me?
Yes, yeah. What was interesting to you with this record revenue at Live Nation, for example?
I mean, listen, the fourth quarter is a seasonally small quarter for them, so they did beat expectations a little bit. So I'm less interested in what they did, and I'm more interested in what they're going to do. And they're giving a pretty robust outlook for 2026 in terms of their early indicators.
Is it just because people love going to live shows, these big marquee events?
Yeah, well, 2025 for Live Nation was dominated by big stadium shows. That's a little trickier in 2026 because of the FIFA World Cup is taking a lot of stadiums over for during the peak concert season in the summer. So what they're saying is they've kind of prepared for that, and a lot of their growth will come overseas in 2026 because of the World Cup.
What can you give us a ballpark? How much of their revenue comes from the United States and how much from other markets? Can you give us even a rough?
It's interesting. They've really built out their international platform, and it used to be kind of, 70% U.S. and 30% international. Now it's closer to 50-50 now. Obviously, they made a big acquisition in Latin America a couple of years ago. They like to say that social media has, marketed these U.S. artists all over the world. So they can go into markets they never thought about before. And Beyonce is has crazed fans all over the world. So they're following that.
That's interesting. I mean, we hear that COVID made us all stay at home. And to some extent, live events or clubs haven't fully recovered. But people are happy going out to these giant concerts, it seems.
Well, and you were talking about AI earlier in your broadcast. When you look, so many names in media, information services, I cover Thomson Reuters, for instance. So many of those names have been impacted by the AI fear. When you're a live events company, there's no AI replacement for that.
Yes, that's interesting. You're actually at a real world event, IRL as they call it. Yeah.
It's a little bit similar with Disney, where 60% of their EBITDA is parks, right? People are still going to parks.
What about the antitrust? I mean, it seems on, on the surface that it's kind of open to abuse that Live Nation would own Ticketmaster, giving them such a grip on the tickets for live events. Will they ever be forced to divest Ticketmaster?
Well, I think that's the question, right? I mean, the stock is going up. The market investors believe the lawsuit is going to fade away. The actual trial versus the DOJ starts in like 10 days, March 2nd. It's a jury trial. And Live Nation had a big effort with the judge to motion to dismiss that he has rejected. Now, he did agree with Live Nation on some of the points of contention. So, but the trial at this point is going to start very soon. And that's a risk to this story. Now, the wrinkle is that, you know, Trump has said, and this was in the Wall Street Journal, he's interested in getting Live Nation involved in saving the Kennedy Center. So will Trump intervene on this case before it starts? The case has been 2 years in the making.
And is it a possibility is that Live Nation would spin off a portion of Ticketmaster but retain control?
Well, I've argued for years that regardless of whether this trial occurs or doesn't occur, or there's a settlement again with the DOJ, the issue at the heart of it, which is the perceived conflict between being the biggest concert player and the largest ticket vendor, that's not going to go away. Live Nation needs to be proactive. They need to spin off part of this business, set up an independent board, and retain some kind of relationship so they can get access to the data. The issue has been around since the merger happened in 2010. It's not going anywhere.
I'm just looking at the growth of this company, a market cap at the end of last year of almost 40 billion, and back in 2018 it was only about 10 billion. So this company sure has grown.
Yeah, and I think, you know, you have to, you know, the growth rate is sort of modest double digit, very good. Demand is strong. You do have to sort of look at what are they buying, what are they building, and what's actually organic growth, because the number of fans in the U.S. that attended their shows in 2025 was down.
Was down. Why was that? Just not hot product, not enough hot product, hot artists?
You know, it's a head scratcher to me. I think it may be a mix issue between stadiums were strong, but there were bigger shows, but less of them, and arenas and amphitheaters and clubs were not as big a part of the mix. I'm not really clear, but all their growth in fans were overseas.
That's interesting. Thank you very much, Doug. Really appreciate it.
My pleasure.
Doug Arthur, Managing Director at Huber Research Partners. Up next, some small cap ideas for your portfolio. Small caps can offer opportunities for big gains. And of course, they can give you diversification from these big mega cap tech names we talk about sometimes ad nauseum. So let's look at some possible opportunities for investors. Our guests see small cap stocks gaining momentum, particularly with interest in select consumer companies as well as industrials. We're joined by Francis Gannon, Co-Chief Investment Officer and Managing Director at Royce Investment Partners. Thanks very much indeed for joining us, Francis. The Russell 2000 not long ago hitting record highs. It's had a pretty good run, but of course the news is always dominated by Meta and Nvidia and Alphabet.
Well, good morning, Andrew. Thank you for having me. Small caps have actually been outperforming since the April 8th low of last year, and it's hard to believe, and I think most people would be surprised to know that over the past year, small caps are outperforming both the S&P and the NASDAQ through last night. So it's actually been a really fascinating time to see the broadening of the overall market. The story for small caps is, I think, continues to be quite strong. And part of it is driven by the fact that we are going to see significant earnings growth this year. In fact, earnings growth that should actually outperform the large cap names in terms of the S&P 500. So we think we're on the cusp of what could be a prolonged small cap cycle.
We have some suggestions here. ESAB, it's big in welding and fabrication technology and gas control. What attracts you in particular to this name?
Well, I think one of the major themes in the market this year, especially as it continues to rotate here and broaden out, is going to be kind of this idea of reshoring, right? And the reindustrialization story. And I think this is a perfect way to play that in terms of companies building plants here in the United States and the continued growth in what we think will be a better economy over the next several quarters.
Broadly, I mean, I guess anybody involved in fabrication or welding with this incredible build out of data centers, they're going to be seeing more business.
Oh, I think that's all part of it. I mean, it's all part of the economic story you're going to see. And so part of the reason why we are, as a firm, I would say, overweight industrials is, one, it's from a bottoms up standpoint. It's really where we found the opportunity set over the past several years. And two, it has to do with this idea that you've got a bunch of powerful things kind of happening in the United States, and from deregulation to the AI story, which is really going to work its way down into the small cap space. We're fond of saying around here that small caps, kind of AI is coming to a small cap name near you. But this reshoring idea, the tax policy, this idea of 100% depreciation on CapEx and research, I think is pretty significant when it comes to what it's going to do for a lot of industrials. Now, industrials within the small cap space happens to be kind of a catch-all sector, if you will, from machinery type businesses all the way down to services. And a company like ESAB kind of obviously fits right into that sweet house in terms of a lot of the economic trends that we've been talking about.
Another idea, Quaker Houghton, specialized industrial chemicals and fluids company.
Yeah, the exact same type of story here. You're right. The chemical world is one that I think you're going to see continue to expand. Quaker is, we think, a very high quality small cap business. And as the focus of the market goes a little bit away from, and what we've seen at least so far this year, services into more of the, I would say, goods, the chemical and the continued build out from a chemical standpoint and usage of specialty chemicals in a lot of different things will continue to expand. So we're really fond of this particular company, and we think that it has further multiple expansion from here.
And now a very different company, J&J Snack Foods. They're big in snacks and frozen beverages. That's
correct. It's a company that kind of got caught up several years, or last year was down a lot from a performance standpoint. And we think this is a great business and was really kind of a value opportunity for us from a valuation perspective that we think will continue to move out here and do quite well. Obviously, as people are focusing on their weight, this got kind of caught up in that particular moment. And we think this is a company that obviously has unique products, but also has great cash flow, phenomenal balance sheet. And we look for this to be a great performer over the next several years.
Thank you very much, Francis. Francis Gannon has joined us, Co-Chief Investment Officer and Managing Director at Royce Investment Partners. Okay, so we did get the U.S. Supreme Court deciding against Trump tariffs that were imposed. But as I mentioned, the U.S. administration has plenty of options to impose duties in other areas. So the Supreme Court ruled against Trump's imposition under the so-called emergency powers authority that he has. But Bloomberg reporting that he has at least 5 other options here if the International Emergency Economic Powers Act won't fly for him, if that dog won't hunt, as Conrad Black might say. And Tyler Kendall of Bloomberg touched on this already. So he can go for the so-called Section 232, threat to national security. He's done that already. Section 201, injury to domestic industry. There's discrimination against U.S. businesses, international payments problem, and discriminating against U.S. commerce. So there are very varied powers there. Some of them would need commerce to weigh in, and a couple of them would need investigations. But as the White House has warned, we can do this another way. You can see the broad U.S. stock market is up. Let's have a look at the Canadian dollar, because we did see some weakness in the U.S. currency immediately after this ruling came out. In theory, this could be good for Canada. And our market, well, our dollar pretty flat. It did blip up. But if some of these tariffs, notably on steel and aluminum, are ratcheted back, but as I said, there's a lot of tools that the White House can utilize here if it wants to go on with that policy. We did get more from Trade Minister Dominic LeBlanc on social media, saying the U.S. Supreme Court's decision reinforces Canada's position that the International Emergency Economic Powers Act tariffs are unjustified. While Canada has the best trade deal with the U.S. Of any trading partner, the government keeps beating that drum, we recognize that critical work lies ahead to support Canadian businesses who remain affected by Section 232, tariffs on steel, aluminum, and automotive. That's the one I mentioned. Those are the threat to national security tariffs. Canada, we're in a period of transformation in Canada's relationship with the U.S. as we approach the first joint review of the North American trade deal, and we're working to create opportunities and expand our collaboration with reliable trading partners and allies around the world. I guess you could get AI to write some of that stuff. Anyway, that's the word from Dominic LeBlanc, the Trade Minister. Coming up, we'll check out 3 hot picks in biotech, including one company that's advancing treatment for nervous system and neuropsychiatric conditions. Stick with us. Hot picks. Our guest has a company working on advancing treatments for central nervous system problems and neuropsychiatric conditions as its top selection. We're joined now by Joe Thome, Senior Research Analyst in Biotech and at TD Cowen. Thanks very much indeed for joining us, Joe.
Thank you for having me.
I guess it's a reminder to eat our bananas. This first company is working on potassium and the mechanism in the body. Tell us what catches your interest with Xenon.
Yeah, so Xenon Therapeutics is a Canadian biotech company actually progressing potassium channel openers for the treatment of seizure disorders, specifically focal onset seizures. The company released very strong phase 2 pivotal data several years ago, and now investors have been waiting a few years for the phase 3 to read out, and that's going to happen here in March. And our epileptologists tell us that the holy grail for a seizure disorder drug is one that you can take once a day with no titration, plays well with other seizure disorder drugs in terms of drug-drug interactions, and obviously is effective. Right now, about 30% of focal onset seizure patients don't have anything that they can use and still have pretty refractory seizures. Xenon and azetukalner have produced some of the best seizure reduction data that we've seen so far. So this is a biotech favorite, and hopefully when the phase 3 data come out in March, we will see continued strong results, and the stock will hopefully climb, at least 30% here.
Your next idea, it has a rather boring name, United Therapeutics, but they're involved in working on acute liver failure.
So the main program for United Therapeutics, they definitely have some programs in liver failure. Why the company is known, though, is for their portfolio of drugs targeting pulmonary hypertension. So right now, they have a suite of oral, inhaled, and IV drugs for pulmonary hypertension. And the one that has really taken off recently is Tyvaso. This is their inhaled option. And while the drug is doing well so far, it's expected to do about $2 billion in revenues probably in 2026. The main growth opportunity for them is going to be in idiopathic pulmonary fibrosis. The drug produced very strong phase 3 results last year and is on track to release another phase 3 study at the end of the first quarter or early second quarter this year. Idiopathic pulmonary fibrosis is a progressive disease that really hasn't had a ton of innovation in recent years. The two main drugs that are used, Ofev and Esbriet, slow decline of symptoms, but they have pretty problematic GI side effects, and our physicians say about 20% of patients discontinue therapy. Tyvaso can get around these GI side effects and has shown best-in-class efficacy. So we think that United is on the road to a potential breakout here. Even with those problematic GI side effects, the leader in IPF makes $4 billion in annual revenues, which would be a very large growth opportunity for United over the coming years.
So one of the problems with in this area has been treatments just give people digestive problems?
Yeah, so it causes some pretty severe nausea and diarrhea, and to the level where even though these patients have a pretty severe pulmonary condition, they just really can't tolerate the existing standard of care. And our doctors say within a year, 20% of these patients come off. And while there's a little bit of cough with Tyvaso, you don't see those GI side effects. So we're hoping we can get an effective therapy with some better tolerability.
Your last idea, Axsome Therapeutics. Tell us what they're mainly working on.
Yeah, so Axsome is a neuropsychiatry company. Their lead asset is called Auvelity for major depressive disorder. That drug is doing about $500 million a year. And compared to your typical SSRIs or SNRIs that you use for depression, Auvelity has a very fast onset of action within the first week.
Wow.
It doesn't have adverse mood effects. Yeah, and also. It plays well with other drugs as well. So it's doing well in major depressive disorder. The next leg of growth here is going to be in Alzheimer's disease agitation. So about half of the 7 to 6 million patients in the U.S. with Alzheimer's have symptoms of agitation. And patients and caregivers indicate that this is a pretty severe side effect of the disease that needs to be managed. There's only one other drug, Rexulti, that's out there to manage Alzheimer's agitation. But again, it has a black box for mortality and doesn't work that well. And so our physicians are really excited about Auvelity for Alzheimer's agitation. And it's with the FDA now with a potential approval date of April 30th of this year.
That's amazing, an antidepressant that kicks in that fast. Thank you very much indeed for joining us.
Thank you for having me.
Joe Thome, Senior Research Analyst in Biotech at TD Cowen. Coming up, one last check on the markets as those Trump tariffs on the basis of emergency powers have been struck down by the U.S. Supreme Court. That's ahead. So just to remind you, the U.S. Supreme Court has struck down tariffs that were imposed by the U.S. administration under emergency powers legislation. And you can see stocks reacting marginally positively. But as I mentioned, there are lots of other options that the administration has indicated it's willing to use. We heard from Dominic LeBlanc. I should have clarified, he's Trade Minister for Trade with the United States. And then Maninder Sidhu is the Minister for International Trade. LeBlanc is also Minister for Intergovernmental Affairs, Internal Trade, and One Canadian Economy, whatever that means. There is a look at the broad stock indices. You can see they are up. And we did see a rally in some apparel stocks because, of course, the clothing retailers do tend to bring in stuff from Asia. Oh, Nike, though, giving up the gains. It did move up, but now barely in positive territory. Gap, GPS also saw a boost. I think it's GPS. And, of course, they will... Gap. Oh, now their symbol apparently is Gap. Yeah, that's more logical. Lululemon, also up, but giving up the gains. Obviously, the White House will be working furiously on a response to this. And the court also saying that President Trump exceeded his authority when he imposed import taxes that the administration says were aimed at addressing fentanyl trafficking. And remember, a lot of drug experts have expressed skepticism that much fentanyl makes its way from Canada into the United States. I wouldn't be surprised if at least some, though, does. And there's Ford Motor Company up around 1%, because, of course, tariffs on the face of it bad for our integrated auto system. Stellantis jumping 4%. Thanks very much for watching The Open. Morning Markets is up next.